Right, ladies and gentlemen, welcome to this session, Brexit, a red flag for global financial harmonization. I'm Ross Westgate, I'm the moderator for the session. And as we all know, it's an interesting time. The whole conference has been talking about this. We're at a point where global financial regulation, of course, has really been dictated by the financial crisis back in 2008. And it's extraordinary to think that we're still living with the emergency rates 8 years on that were enacted then by central banks around the world. And of course, regulators have been focused on preventing systemic risk, the too big to fail question, and everything has been counterparty risk. And so global financial regulation has been dictated by those events. But in this session, we're going to look at, is that going to change? Are the politics that we're witnessing around the world, whether it's the president-elect in the United States, whether it's Brexit, whether it is the political changes afoot in Europe and elsewhere, going to change the nature of harmonization and the direction in which regulation of financial services is going, and also touching on whether the new institutions, new financial intermediaries, are also going to change these industries. To do that, we have a fantastic panel. So I'm delighted to welcome Mr. Youssef Boutros-Ghali, former Minister of Finance for Egypt and former chairman of the International Management and Finance Committee. Colin Ellis, who's Managing Director and Chief Credit Officer for Europe, the Middle East and Africa at Moody's. Dominic Lester on my left, who's Managing Director and European Joint Head of Investment Banking, European Head of TMT Investment Banking and Joint Global Head of Technologies at Jefferies. We have also Joe Cassidy, who's Lead Partner for Brexit at KPMG UK, and also a lead partner as well for intermediaries and infrastructure in the financial industry. And finally, but by no means least, Sanjay Patel, who's head of Europe and managing partner for Europe at the European Principal Finance Business at Apollo Global Management. Welcome to you all. Thanks very much indeed for joining us. Youssef, if I could start with you. As I mentioned in my introduction, the architecture of regulation has devolved from post-financial crisis, and it's been centered on preventing a repeat of that, a too big to fail scenario. In the light of what we've seen with policies emanating from President-elect Donald Trump, in light of the Brexit vote, and in light of political changes undergoing at the moment in Europe, do you see the direction of travel or the nature of regulation and financial harmonization changing? Are the politics going to make a fundamental difference?
Well, we need to look at three dimensions of the issue. The 2008 crisis, Brexit, and a global retrenchment in the world away from globalization, taking various forms, the US, Italy, etc. For the 2008 crisis, it has led, as you said, to a whole infrastructure of macroprudential regulations meant to diffuse any systemic risk and put circuit breakers all over the financial system so that we don't have a repeat of 2008. I don't think anything is going to change that. It may change the intensity as countries begin retrenching from globalization. They may get confused and start retrenching from a supranational regulatory infrastructure. But I doubt that. I think that everybody realizes that it is for the benefit of all that we don't have in some lost corner of the world one bank that can bring the whole system down. So in that sense, I don't think that the macroprudential infrastructure, the FSB regulatory infrastructure will change in any significant way. The second element is Brexit. Now, Brexit is a choice made by the British people, and what it will do, it will change the relationship of the British economy with the outside world. Now, that is, no matter what happens afterward, whether it's a hard or a soft Brexit, there'll be a shift in the comparative advantage of the various sectors of the economy. This is something that happens every so often, every century or so. There is either a technological change or a political change that rebalances the economy from the inside. Comparative advantages change. What we will see in the British economy is a movement of resources from one sector to the other. Some sectors will thrive, others will have problems. Most likely one can anticipate that the financial sector, the service sector more generally, which represents about 80% of the British economy, will fare better vis-à-vis Europe. Not because of what the Brexit will come out with, but basically because of the very heavy labor laws and very heavy labor burden, regulatory burden on labor markets in Europe. So it's unlikely that an exit from the Union will give a bigger advantage to those who remain inside compared to Britain in the services sector.
Yeah.
The last element is this retrenchment from globalization. And here, anything can happen. Literally anything can happen. There is a popular resentment due to the maldistribution of the benefits of globalization, and that is being reflected in a retrenchment away from it. You listen to Trump, you listen to various politicians in France, in Scandinavia, everywhere. There is an anger that comes out from the fact that the benefits of free trade and the benefits of globalization, while they are definitely positive on a macro scale, they have not been equally distributed on a micro scale. And those who haven't benefited from it are fed up. Now, what this will lead to, no one can anticipate. I would suspect that after a few years of confusion, a number of governments will establish systems whereby the benefits from those who benefited from globalization will be partially redistributed to those who did not.
Okay, well, let's pick up on a couple of those areas. We've got Brexit and that last point as well with the rest of the panel. Let's start with Brexit, because it's in the title, a red flag for global harmonization. Do you think, Dominic, if we come to you, that the UK is going to... There's an opportunity, one way of looking at Brexit is they say, well, there is maybe a regulatory opportunity here to potentially say we might change the regulations to enable the financial services sector in the UK to compete better. Do you foresee that happening?
Frankly, I don't, because I think there's a number of issues to consider. First of all, I think when it comes to the regulation that's been created for financial services, a lot of that, while it's been created by the EU, it was created very much with input and a strong push by the UK. I think the UK regulatory authorities, the FCA and various regulatory authorities, are as focused as any regulatory authority on preventing systemic risk and changing the behavior of financial services institutions. I deal with, we're regulated by the FCA. We're not a bank, but we're regulated, one of the largest institutions regulated by the FCA, so we deal with them on a regular basis. They have a fundamental view that the behavior, conduct, which is sort of a fuzzy concept, has to change for people in the financial services industry to behave more responsibly. And politically speaking, there's no doubt in my mind that while the financial services industry in the UK is important to the economy, there isn't a desire for the financial services industry to become a larger component of the economy, quite the contrary. So I don't see the notion that the UK is coming out of the EU as an opportunity to create a new Singapore with more lax regulation, encouraging more financial services organizations to come into the UK. Quite the contrary. In fact, if there's any chance of passporting to occur for UK institutions based in the UK, there needs to be equivalence of regulation. So one of the ways to ensure passporting is through MiFID II, but that requires equivalence of regulation in the UK versus the rest of Europe. So I guess the short answer is, I think Brexit is about, personally I think Brexit is less about immigration concerns and more about governance and self-determination and all the principles of democracy which the UK invented. There's a very good book, by the way, by a guy called Daniel Hannam called Inventing Freedom, which talks about the history of democracy. And I think if you ask the average Englishman, does he want to see big government, let alone government from a foreign nation imposing rules and regulations on the UK, the answer is no. I think the people want to have their destiny determined within the UK, but they also want more freedom. But frankly, I don't think the average person wants to see the financial services industry become more dominant than it is today. Quite the contrary, I think they want to see the industry serving their needs.
I mean, interesting is the UK has been at the heart of designing financial regulation for the rest of Europe, and I wonder, Joe and Sanjay, whether that where the counterbalance is, well, how that impacts on European regulation if the UK leaves Brexit?
I think the regulators, in some ways, maybe it's what Boutros was saying, which is they're supranational. So these regulators definitely talk to each other. So the FCA, BaFin, the PRA, the Bank of Italy. And so to some extent, I think there's politics, which dictates, I think, the sentiment of people, and it's going to be extremely volatile. And I think there's a little bit of what I call the overlay, the structural overlay, where I think these regulators talk to each other, and I don't think it shifts. I think the question is, do they have to harmonize more? And yes, if politically there are pressures for the UK banks to do more lending in the UK, how do you kind of judge all of that? I think the big
to get more lending in. Let's look at that, because that's always been the politics is bash the banks over the head, hold more capital. We want you to have higher capital ratios, but at the same time lend more, which seem to be diametrically opposed to each other.
I think that's and we can talk about it. It's a global phenomenon. The big issue I think this regulatory overlay has kind of created is, in a very low interest rate environment, is a very, very, very difficult for the banks and increasingly with Solvency II and the insurance side, for them to hold assets that are needed for growth. And that's fundamentally a problem. And so guys like us are taking advantage of it because we're stepping in as an investor, backed by liabilities which are long dated, i.e. pension funds and sovereigns, to put money to work in those asset classes. Whereas a bank, which is a deposit entity, or an insurance company, which has insurance liabilities, the regulators are much more worried because the policyholders or the shareholders are people, and so they're worried about protection of those people. By the way, they all buy the same assets, right? So we buy credit assets, insurance companies buy credit assets, bank try to buy or syndicate or hold credit assets. So we're doing the same things, the form of our liability structure is different, and I think the regulators have kind of lost sight of ultimately the ultimate goal, which is lending.
Well, that comes back to what the politics behind this, because is it, Colin, is it about trying to get an industry to get capital to where it's needed, or is it about preventing something happening? And obviously regulators are very good, or politicians are very good at regulating for the last crisis, not looking ahead to the future one. And Sanjay mentioned Solvency II as a supplementary. I wonder whether UK insurers who dislike that piece of legislation intensely will look for an opportunity to have it removed.
So there's a lot of questions bundled in there. I try and take them one at a time. I think the notion that Brexit presents an opportunity to revisit some of the regulations, sure. There are going to be all kinds of groups lobbying politicians for the things that they like. I actually have a lot of sympathy with what Dominic said before. I think actually in the UK, given the size of our financial services sector, there is a recognition among policymakers that we need to make sure this is as resilient and robust as it can be. And indeed, to come back to one of your previous points about is it capital or lending, part of the point of the Bank of England's recent stress tests in the UK was actually they forced an assumption on the banks that they continued to expand lending. So it wasn't a case of, here's a really bad event, what does your capital fall to if you take all of these management actions, including deleveraging? It was, can you still meet the needs of the economy to provide finance, the intermediation services that is at the heart of the banking model, and still maintain a robust capital ratio? So I think it's both. I also think, though, that I think that most policymakers recognise that you're never going to stop another crisis. At some point, something will go wrong. But there is a realisation that the way the costs of the crisis are distributed matters, and it comes back to the point about inequality that's cropped up throughout the sessions today. But fundamentally, the 2008 crisis was probably the biggest market failure in living memory, because it imposed massive externalities, massive costs on people who weren't involved in the decision-making processes that led to those costs building up. So, the recognition that something had to be done, I think is still there. I think it's still very strong. If I can just kind of tack back to the kind of title of the panel, red flag for global harmonization. Financial harmonization. The interesting thing is, while there's been that recognition that you don't want to resort to bail-ins straight away anymore, the way in which different countries have gone about doing it does different. It is different. Different things happen. And actually, even before Brexit, even before Trump, even before some of the populist tendencies were more evident, there was a fragmented approach in terms of the way that different countries wanted to think about bail-in, how they wanted to think about managing systemic risk. There was a fragmented approach globally in terms of the subsidiarization model that the PRA imposes on subsidiaries operating in the UK, and indeed US regulators impose there. So this was already kind of happening a little bit. It may be that we see a bit more of it because the extent of the rules that are agreed at the global level and implemented from the global level is actually limited to the kind of TLAC and GSIFI discussions that are still ongoing.
Joe, does that lead to greater, are we going to see more regulatory arbitrage as a result?
Well, I think, you know, the key objective on a lot of the regulation was based on a principle that banks live globally and they die locally. Okay, and the resolution thereafter of those institutions within those respective jurisdictions, because of differences in insolvency law, subordination structures, etc. All of those things result in differences of implementation in respective jurisdictions. So you do get a balkanization of capital. You do get a loss of the efficiencies that would have been there in terms of treating these entities on a global basis. Just coming on to what that resulted in before coming back to your question, it resulted in a lot of simplification. The G20 derivatives reforms were all about simplification, transparency, reporting, finding out actually where the risk was, because that wasn't apparent prior to that point in time. And the, if you will, the derivatives and other asset classes converging in on central counterparty clearers, the infrastructure holding, if you will, the risk rather than, and it being mutualized by the members in a transparent way. That's where we ended up with in a lot of this. Now, the irony of that is that actually you get centralization of that risk in certain jurisdictions, the UK being a really important one on a global basis. And that, you know, going back to your to the Brexit question at heart, means that people still need to have to access the UK market in a post-Brexit world, and moving that open interest and those other assets and that liquidity out of London, which is acted like a centrifugal force because of law and the certainty that it gives and all of those other areas, the continuity of access for European institutions and indeed global institutions into the UK is a really important factor.
So how does that play out in any Brexit negotiation or any positioning of London's financial future as a financial centre?
I think it plays out quite strongly, to be honest with you. You know, it sounds the market infrastructure is a very esoteric area. It's not well understood. It's the plumbing, and it's where a lot of risk has ended up. Now, you can't just change that easily. You know, there are trillions of dollars of interest rate swap risk in LCH as a case in point. You've got pieces of infrastructure like CLS, the continuous link settlement, the netting of foreign exchange on a day-to-day basis. Those things reside in the UK for a reason. It's language, it's time zone, it's law, its skills. All of those kind of things have attracted that infrastructure into one place. So how do you, if you pull up the drawbridge and you say
a hard Brexit,
a hard Brexit, all of those institutions, you know, that access those liquidity pools and that open interest, and indeed their clients who access that. So the real world corporates who are taking advantage of hedge accounting or investment managers who are running LDI overlays on portfolios, they have to be able to access that infrastructure efficiently. And those points are not, they're getting there. You know, we went through the debate in 2011-12 when Dodd-Frank was enacted and subsequently EMIR legislation and regulation was drafted, and there was an education process with Brussels and with other parties in order to explain where those costs go to if you impose that or you fragment it in a particular way. So we've got a long way to go on that. Does that constitute arbitrage? People are always going to look at not just regulation as a consideration, liquidity they're going to and gravitate where that is. They're going to look to where, if they're a buyer, they're going to look where sellers are. Tax is a really important consideration on when people locate and the jurisdiction.
You mentioned Dodd-Frank, and we'll come back to Brexit in just a second. Or London. I'm kind of interested with Trump now as president whether there'll be any rowing back on Dodd-Frank, and in fact whether we might be moving to a stage potentially where we're re-implementing a form of Glass-Steagall at some point that people want to separate out.
Dodd-Frank and Glass-Steagall will sort of, he promised he would repeat both. And again, when you have an inimical attitude towards globalization, when it's formulated in a way that is not very precise, that is not very clear, you can do anything. And some of it can be a mistake. And I suspect that we will see mistakes being made in big financial centers due to repeal of this or that law, forgetting that the law came for a reason. The law came because there was leakage from one financial institution into another, higher risk with a broader audience, like you said, holders of deposits or holders of policies that were not supposed to be exposed to that risk. We've forgotten this. And we're assuming now, for those who are anti-globalization, that this came from outside, when in fact it was homegrown, and the problems came homegrown. So I think in that particular area, not including macroprudential, the issues addressing systemic risks, which I agree will remain as they are and will not change fundamentally. But those that relate to the local organization, local supervision of financial institutions may change. And if they change in a big financial center like the United States or here, this will have systemic effects.
Can I? Yeah. I think this concept of regulatory arbitrage for sure exists today. So we spend a lot of time as an investor in financial services. We own 3 banks and 4 insurance companies. So we've done those deals reasonably recently in Europe and in the US. So we spend a lot of time thinking about and delving into NAIC guidelines and Solvency II and Basel III rules on capital efficiencies. And so, when we buy these institutions as an investor, we actually are taking their balance sheets and putting them into risk-adjusted, attractive return assets for those regimes. And they're incredible inefficiencies. So you can, a mortgage could be efficient on one balance sheet and from a capital point of view and inefficient. Yeah. So we can originate U.S. mortgages and put them on a European insurer's balance sheet. And it's very attractive from a Solvency II point of view. And so because we're students of this, and as investors, we've decided this is kind of an interesting way to play this arbitrage that's going on. It's actually interesting, and I think we think you.
Do the arbitrage opportunities become greater?
Look, NAIC guidelines are complex. Yeah. Solvency II guidelines incredibly complex. Basel III, Basel IV, incredibly complex. And even, I feel for the banks, the big banks, the big insurance companies. We're buying smaller businesses that we can control and build in this environment. It's really hard to kind of navigate this. So are they getting wider? I don't know. Are they going to get narrow? No, because they're different regulators. Human nature is not going to, the US insurance regulators may be talking to the British insurance regulators, but they're not fixing it all. So, and I don't think that's a bad thing ultimately, but, I think generally, they're making it a better systemic risk.
Are we going to move towards are regulators going to move towards a path where we have separation of deposit taking from investment banking? Is that going to return or not?
Well, it's still a live issue here in the UK, right?
Yeah.
Quite how it works is what we're all waiting to see, because drawing that line, that separation between the kind of classic banking model that actually doesn't exist, where you go to a bank, deposit some money, and it's lent out to a company. That isn't actually what happens, but that's still the model everyone has in their head. But as soon as you start doing something as simple as trying to manage your interest rate risk, you're into a world that arguably is an investment banking kind of service. So I think we're watching how the Vickers proposals are taken forwards. If they are, ostensibly, it's still government policy to implement these going forwards. But until we see it actually kind of start to bite and really affect the decisions for the banks in a meaningful way, because thus far it's been kind of relatively light. I think it's hard to predict how it will.
Where you put the wall? Where do you draw the line?
Where is the wall?
Yeah.
Well, I mean, it's been done before with Glass-Steagall. The issue is whether it addresses a problem or not, because we had a breakfast meeting today, and I guess the comment that Mike Milken made, so that's not my thinking.
He's always good for a comment.
Is that, ultimately the problems with the banks go back to basically mortgage lending and irresponsible lending, with the fact that you can basically.
I thought it was irresponsible borrowing. I mean, they were borrowing short and lending long. And that's
well, look, if you get, I mean, the issue is that the rates, the terms upon which banks provide loans to individuals are so much more favorable than the way that provide to corporations or counterparties that are a lot less risky. So, and it was all based on the foundation that property values never go down. So, and that was wrong. So, I mean, that issue doesn't go away if you create a Glass-Steagall separation. You still force banks to lend to consumers and for homes or other types of risky loans. And so that's the biggest issue, is that you have massive balance sheets that still have huge exposure to
But you can
loans.
do things about that. I mean, like, the 4.5 LTI limit in the UK, UK banks are allowed to lend, I think it's 15% of their mortgages can be more than 4.5 times loan to income ratios. And they're not running at that threshold. They're running at about 8 or 9% of the total lending. If you look at the build-up in household debt in the UK in recent years, it's not been mortgage debt. It's been the kind of classic consumer credit type stuff, which is, on the basis of our ratings, you'd say much riskier. So I think you can do stuff even within jurisdictions. You can use these macroprudential tools to try and limit some of the build-ups of the risks, even if you can't ever accurately predict or necessarily stop the crystallization of those risks.
I think one of the things that is emanating from all of this is the nature of the provision of capital is getting narrower to a smaller segment of society. And I think one of the things that's emanating from all of this is there's a huge swath. So we can talk about the mortgage crisis, I agree. But this was led by the U.S. focus on lending, the democratic focus on lending.
And that's because the politics shaped.
Yeah, so politics shaped it.
And so politics is going to shape the next step,
and the banks followed. And so now we kind of cut them back, and which is, I think, makes probably some sense. But then you, in effect, have a huge underserved population who still want to have a home or have a credit card and subprime. And by the way, guess what? I spent some time thinking about, should we set up platforms? And, we've talked about, all of the lending platforms that are emanating, and then there'll be a regulatory overlay on those, which may be fine. And it just really depends on the funding capabilities and how these things are funded ultimately.
But part of your point there, though, is implicitly that you need more capital for those kinds of activities, which, back to the point about inequality and what drove some of this in the first place, that then becomes self-reinforcing, because the whole goal of fiscal policy, or not the whole goal, the mechanism within government for redistribution is fiscal policy. That's part of what it does. So if we want to provide those kinds of services to those riskier borrowers, do we need a subsidy? And forget about mortgages for a minute. Let's talk about SME lending. Failure rates for SMEs are, by and away, much higher than for larger businesses, because if you're bigger, it's a high risk. So then you're into making very political decisions about how you want to treat different categories of lending, how you want to allocate capital or encourage capital allocators.
And typically, the SMEs are the ones who benefited the least from a globalization movement. So these are the ones you'll have to cater to, and you'll have to take care of, as you say, through maybe subsidization of their capital.
Which brings us very neatly onto Eurozone, where we know that the vast majority of capital still has been accessed through the bank system. Yeah. The banks have been hobbled. We've just had a referendum in Italy. Renzi's resigned. We don't yet know how that will affect plans to recapitalize the Italian banks and whether they can get around doing it off the state or not. But bearing in mind that the banks are so much more implicitly fundamental to the health of the economies in the Eurozone, how is the changing politics, or how is politics going to affect that lifeline of the Eurozone economy?
So just on the, if you look at the priorities for the various technical boards and committees in Europe. It's focused on two things initially, and Yusuf talked about this at the beginning, the asymmetric risk and the symmetric risk, so how you firewall those off. Those were defensive strategies around Europe. The next phase of this was very much supposed to be about capital markets union. So, and you take the SME segment as a case in point. In the US, you have transparency and a central register of SMEs, and they're categorized, and people, can securitize and invest and know what they're getting. You don't have that across Europe. So that agenda is still yet to be pursued, and in many cases it's going to break down, it's going to stall as a result of Brexit. You may have the EU 27 coming together, but you don't have the distribution mechanism of, say, London, for instance, where people can meet and invest through that. And people still set up here. So take SoftBank, setting up with the Saudi $100 billion fund only, 4 or 5 weeks ago, domiciled here in London. The Chinese institutions coming to London and using that as a gateway in order to look at assets and invest through. That starts to break down, and the objective of actually funding and creating growth across Europe without London being part of that is going to be extremely challenging, particularly if there's a distraction of Brexit while you're trying to get to some form of capital markets union with the residual 27. So those kind of issues are still out there, and each incremental step in the Eurozone on this convergent path is taking that little bit longer, and it is that little bit harder.
Sorry.
So, the point I was trying to make earlier is that credit is available. The question is at what price, and is it appropriately priced for either consumers or small business or whatnot? And what the regulators are trying to do is push credit, sometimes subsidizing it, effectively forcing the banks to subsidize, whether it's mortgage loans or other types of loans. But where the credit is available, whether it's the form of sort of online consumer lenders or online SME lenders, the regulators have gotten in the way of that by trying to limit the pricing, effectively trying to, again, get those organizations to effectively not lend because they're not allowing them to price the loans appropriately for the credit risk that they're taking. So
not in the UK.
We're not talking about Wonga here, are we?
Yeah. Well, my point is that the point is that there's a lot of capital that's available, and for consumers or businesses, but it's got to be priced appropriately. And the question is whether regulators are helping people get access to that capital, or whether they're getting in the way of it. Because there's an analogy: if there's a snowstorm in New York City, for those of you who've ever been in a snowstorm in New York City, you arrive at LaGuardia Airport. If you force cab riders to charge a regular fare, they're not going to drive out in the snow and pick you up. If you allow them to charge whatever the hell they want to charge you, they'll come and pick you up. So you've got to let the market, at some point, you've got to let the market just provide the capital at the right types of pricing, and the regulators aren't actually helping in that regard.
The Uber surcharge.
So I kind of somewhat agree with it. I'm not sure that, the banks, so the thing that we see is that the banking system in Europe is still 40 plus trillion relative to a 15 trillion US system. And there's probably 10 trillion in insurance. It's a 55 trillion asset class, 17 trillion economy. US
spread amongst a much greater number of institutions, right?
Spread a lot, but an aggregate, the institutional size is huge. They're trapped by this regulatory framework. They're trapped by a lack of securitization. The securitization markets in the US are 4 times the size of the European markets. So the US does not have a problem. I think Europe has a problem. And I think within each country, different standards were applied on bail-ins and issues, and that's all coming, that's still in front of us. Italy's in front of us. And so the question, so you've got a huge amount of financial assets trapped in these regulatory environments, and then you've got the provision of capital to new markets, which I don't think is infinite, because it's not clear, we're not rushing into every market saying, there's the right pricing for every market, because I think there's a lack of capital.
Well, I was going to say, is there what is the opportunity for new financial intermediaries, right? Where if you're a legacy business, you are hamstrung. Yeah. What is the opportunity for new intermediaries to come in and shake things up, get capital to where it's needed at a price that makes sense? Should regulators be doing more to enable new businesses in this space to grow?
I think they should, but they're not. I'll give you examples.
Why not?
I think they're trapped by trying to protect what they have and deal with what they have. So we're buying businesses, good businesses. Banks are selling. There's $2 trillion of non-core stuff and NPL stuff still in the banking system. $2 trillion. To buy that, you need, 30% equity. You need $600 billion of equity into the European financial system. We have a fund of, a couple billion or $5 billion. It's not that much. Banks are being forced to sell good businesses, consumer businesses in some cases, which are generating high returns because their risk-weighted assets against those businesses are too high. So they're juggling their capital positions every day, every quarter. They're selling stuff that they shouldn't be selling, and they're holding on to legacy books because they have to. So I think, are the regulators saying to them, no, that's a bad business decision? They're not doing that, which is beneficial for us as a buyer. And then the question for us is, how do we make money in that business? What's the ROE of that business? Can we capitalize it? Do you want to own it? All that stuff. And that's not easy because we've got to get funding for those businesses. And if it's not a bank is a good form of funding. So I think the regulators they're trying to kind of go back to protecting and managing a big balance sheet and these very big balance sheets, still trying to clean them up. And that's going to take a long time. So on the fringes, they're letting guys like us navigate, and they're putting a little bit of they're questioning a little bit of what we're doing, but they're not, ultimately encouraging us to do it.
Can I also just look at the competition element potentially between areas as well? When you look at what the US, you've got new Department of Justice coming in, looking what's going on Deutsche Bank, and the American political system might be sitting there and looking at the way Apple's being treated in Europe. Is that going to come into play? Political
That's the
tit for tat?
In the financial sector. Retaliatory trade measures, when it comes to finance, it takes the shape of Apple on one end and Deutsche Bank on the other. But my question is just before this. Wouldn't it be more predictable if the funding system in Europe moved towards the US model, where most corporate funding is done in the market, outside of the banking system, and the banks are not that crucial to the corporate world, whereas here they are essential. Now, why do we not assume that the borrowing structure of corporates would start sliding slowly towards the US model, where granted systemic risk would be higher because markets tend to diffuse risk everywhere, but where also the regulatory infrastructure is different?
So you come back to this point about capital markets union, which is you need a framework for those things. You also have fundamental differences between sovereign risk in Germany versus sovereign risk in Ireland, and there has to be a consistent approach to that. There isn't a European investor prospectus. There isn't a coherent set of terms. That's part of what is supposed to be being developed through capital markets union. So it requires that kind of infrastructure and standardizer, and then you've still got tax and frictional costs and all of those kind of things.
Well, wouldn't London be the ideal place? And therefore, even after Brexit, you would still maintain the primacy of the London market?
I think there's a couple of things there. One, clearly Brexit, the direction of travel is Brexit. The question of is hard, soft, and what negotiation occurs is yet to unfold. Logically, people feel, I go back to these things about time zone law, certainty, transparency. Where do you get that in one place or two places in the world? You probably get it in the UK, and you probably get it in the US.
Yeah, and not in Frankfurt or Berlin.
Not
or
to
Paris.
the same extent. Not to the same extent.
Right.
But I get the sense that European policymakers are now waking up to this. We're obviously talking to as many people as we can about Brexit, and I think they're realising that, okay, some activity may shift, but probably not as much as was originally touted. And if it shifts, it might not go to Paris or Frankfurt. It might go to New York.
New York.
That's,
do you feel that New York is more likely to be a bigger beneficiary of Brexit than anywhere else?
Yeah, I mean, put it this way. If I tell people in my firm that they've got to move to Frankfurt or Paris, their job, they'll say, well, we're moving to New York instead. But I think that back to the sort of bank lending and capital markets, it goes back to the point I made before. If you when we go pitch a client on a high yield bond or any sort of capital markets debt financing, they immediately focus on the cost of that financing, the interest rate, rather than the flexibility it provides them. And the reality is, whether you go to France, Italy, the UK, Germany, the banks are willing to lend at prices that don't make any economic sense for the banks and make a lot of economic sense for the corporate issuer of that debt. And so, you go to any CFO, he's going to say, fine, but I can borrow at, 2% versus, 6%. I'm going to take the 2% any day, even though I recognize there's more covenants, I realize the term is shorter, et cetera, et cetera. And again, it goes back to the fact that the banks, in my opinion, are lending. I don't think they're doing it economically. I don't think they're allowing the market to price that risk, whether it's in consumer lending or in corporate lending. And all of the things that the regulators are doing are encouraging that dependence on the banking system that's fundamentally broken. And a lot of these banks aren't willing to recognize the value of the loans they have on their books because they don't have to, and there's no proper accounting rules to actually force them to do it either. So it's just, we just keep pushing the problem into the future.
And QE doesn't help that situation.
No. I mean, I do think Italy is going to show how bad it was. I mean, it is showing, right? I mean, look, Monte dei Paschi's, they're going to have to bail it out.
Yeah.
It's a disaster.
But the politics of bailing that out
it's all ahead of us,
Yeah.
right? I mean, so none of us know. I think that, this bank and then UniCredit's going to raise $10 billion. The market cap of UniCredit is $10 billion.
Yeah.
Monte Paschi was trying to raise $5 billion of equity. The market cap was $500 million. By the way, who is putting this money up? And by the way, if they are, as an investor, and they don't know what the balance sheet really is, they should really think about their ability to invest in these institutions. It's shocking. It's really amazing. And I think part of the problem that you've seen is this is, 40, 50 years, and it's now at a point where, and by the way, Germany's not that far behind. The German banking system, for all of the strength of Germany, has big issues, which is, I think, and oddly, I think Germany still has to deal with its own banking system.
Is there the political will to do it?
No, look, they have basically guaranteed their banks, which is why you never hear about any of this stuff. And so, it's pretty, but when you start looking at what by the way, we weren't lending in Germany, it's lending outside of Germany. So it's not that the Germans are leveraged themselves, I think. But for sure, I mean, it's just, it's a powerful economy which will deal with its banking system. Italy can't.
Well, I mean, I agree with a lot of what's been said. Maybe we're pushing it to extremes in some instances. But if I come back to the issue about kind of banks versus market finance, I mean, I'm from Moody's. We'd love to see more market-based finance in Europe. But if I think about the barriers, apart from the kind of institutional ones like infrastructure and prospectuses, it's really all hinging on this point about credit risk and the pervasiveness of sovereign credit risk for other issuers in that country. Because one way of characterizing the capital markets union is that you're trying to persuade German savers to fund Portuguese companies without using the banking sector. And when you put it that way and you think about the risks that are involved in that, you understand why some of these cross-border flows just don't exist. Because actually, the euro area has a capital surplus. There's no shortage of capital in the euro area. They've been exporting capital for about the last 6 years because they have a trade surplus. And it comes back to this fundamental point. If you want to address that issue of different levels of sovereign credit risk, which are borne out, they're evident in ratings and they're borne out by the fact we've had 3 sovereign defaults in the euro area since 2012. The mechanism for redistributing and rebalancing public and private demand is fiscal policy. And it doesn't exist. So even with a common prospectus and even with common insolvency rules, you're not fundamentally going to change the price of credit because the risk is different.
So you have got a currency without a state.
Yeah, that's the fundamental problem. Yeah. Until the politicians, Yusuf, are willing to address that fundamental issue with their electorate, we are stuck in a no man's land where the situation in the economies get worse.
Central authority to be able to complete the circle that is not complete now with the euro as a currency.
But the danger of the current politics is there is no politician willing to, even though everybody knows what the answer is, there's no one willing to stand up to the electorate and go, if you want to keep the euro, if you want to make the economics better, create jobs, then we need to finish the project. But there's no one in Europe standing up, whether you're in Germany or Italy or anywhere else, saying, actually, to keep the euro, the cost is this. This is the price of this currency becoming successful.
Can you imagine a politician saying to his electorate, I'm going to give the tax authority to Brussels on all of our economy? He'd be butchered on the spot.
So this uncertainty is going to prevail probably for another 15 months. If you look at what happened in Italy at the weekend and what it probably means in an election in 2018, we've got 3 major elections coming up next year. So which politicians are we talking about is yet to be determined.
So I think it's kind of interesting then to project forward and think about if we're talking about harmonization, whether things are going to grow together or grow apart. One wonders, London is you point out, because of the infrastructure basis, London's probably in a better position than many people might have thought. And one looks at the politics with President-elect Trump in, one wonders whether, in fact, what may happen is you might see the UK and the US growing closer together, perhaps with Canada, perhaps with, do we see financial harmonization or financial regulation going in a different direction?
You'd have an Anglo-Saxon free trade area versus a European free trade area. And that, I don't think, would be for the better for the global economy.
Is it possible? But it's possible?
Look, if the UK entered into a free trade agreement with North America, that would substitute beautifully for the European free trade agreement. It's the same size economy, more or less.
But there are these, I'm sure you're aware, there are these things called gravity models. Yep. And, the sheer distance, it wouldn't substitute permanent perfectly.
But I'd say the UK is the closest you have to the US. So the way the Bank of England and the UK regulators dealt with the banks post-crisis was the closest to the way the Fed and top was. So to some extent, you're seeing the UK banks, in a better position than any of the other European banks. The French say they don't have a problem, which is probably kind of true. The Germans have a problem, the Italians have a problem. So the UK systemically, I think, is much closer, and historically has always been closer to the US from if I just think about it as a financial economy, and then all the infrastructure and everything else we've talked about. So I look, are they, can they get closer fiscally? Yeah, maybe, but I mean, I still think it's the best place to invest in Europe. I mean, as an investor, I'd rather invest in the UK than pretty much any, given the price of, given everything is overpriced. Yeah. I'm not, I think the UK is hard, but would you rather be here than
and just because we'll see if there are any questions on the floor. Just extending it, where does the rest of the world come in? Where do you talk about new institutions coming here, Chinese institutions. Where does Asia and what they're doing impact here?
Go ahead. I mean, I'll just go quickly. I mean, I think the Chinese financial institutions are exporting capital as fast as they can. And they're doing the things that you've seen historically. They're making bad economic decisions.
We're worried about their system.
So they're buying things that they shouldn't, and so I think you're seeing it. Look, it's great. Maybe they'll buy stuff from us, at a high price. So I think that's all that's good. But so I think the Asian, and look, I think the Chinese banks have issues. I mean, for sure there are big NPL opportunities in China. The issues are, are you interested as an investor in investing where there's not a rule of law?
But I think I was going to say, I think it's much broader than just banking, that question, because it's a geopolitical security question, without any shadow of a doubt, and the alliances that are formed around that. And if you look at the UK, and I would say this, wouldn't I, because I'm from the UK, but there's a lot of intellectual property in the UK. There's a lot of stuff that's been invented here, and a lot of IP in a lot of sectors. It could be pharmaceutical, it could be in technology. There are other assets that people are interested. Automotive, Ford has its engine design centre in the UK. Tata, who owns Jaguar Land Rover, has its centre of excellence for automotive in the UK. These are much broader questions. They're about trade, cross-border facilitation of trade. And as things become more balkanised, one of the other things I would say is that, just going back to the banking model for a second, the correspondent banking model that I kind of grew up with in the late 80s, early 90s, that starts to come back. Somebody's got to be that bridge. And in the lit market, and then somebody's got to be a bridge on the, if you will, on the unlit darker market, the off-balance sheet market. And specialist companies will obviously take advantage of that. And that's one of the things about intermediaries. If it's not on an exchange and you can't get access to it, then somebody's got to be able to do that.
One thing I'd say about what Brexit has done is it's forced the question as to whether there is a link between the United Kingdom and Europe. And when you look at it from a political or legal standpoint, there really isn't, because the UK has, unassailable property rights, which don't necessarily exist in Europe. You have representative government, which most of Europe has lived under some form of dictatorship or autocracy for most of its
recent history.
No, right. You have an independent legal system that is based on precedent and applies to everyone rather than being effectively directed by principle and the government, which is not the case in Europe or most of the world, except outside the Anglo zone. You have, complete freedom of the press. I mean, these are all principles that ultimately govern where capital goes, where people are willing to put their money. And, when we talk about moving, people in our industry to Frankfurt or Paris, I mean, the labor laws in those countries are prohibitive. The costs of actually having people there are prohibitive. It's not going to happen. No one can afford to make it happen from a practical standpoint. So I think, the issue is, unless Europe changes fundamentally, I do think the United Kingdom and the US and Australia and South Africa and whatnot are going to get closer together, and Europe is going to be left behind.
On that point, I don't know if any questions from the floor. Yes.
So this question's for Dominic about the pricing of credit. I was at the SME Finance Roundtable this morning, and they were talking about the referral system here in the UK, where if a bank is not going to approve a loan to a corporate, then it has to be referred to a fintech company that can essentially price it however they want. So do you think that over the longer term, that's going to have an effect on sort of the free market pricing of credit products like you mentioned, or you think that that's just going to kind of remain stagnant?
I mean, I think today, there are various startups, Funding Circle, On Deck. There's a whole bunch of them that not even startups anymore, they're real businesses that will provide you, small loans in all forms for small businesses. So I think that trend will continue because their cost of actually analyzing the credit and acquiring a customer and servicing that customer is ultimately much lower than the big banks, and the big banks don't want to service small borrowers. It's too expensive for them and too risky. So I think it's inevitable that you're going to have a new industry, depending on how the regulators are allowed to develop. The question is whether ultimately, when these providers of capital get too big, if they start getting regulated the same way as banks, then that sort of defeats the whole purpose. So it comes back to whether regulators are going to allow the marketplace model to take over, where effectively you're matching borrowers and savers. I mean, today in China, most rich people basically lend money to other consumers because they get the best returns on their money. It's better than putting money in the bank, and there's a huge marketplace lending model in China. There's no reason why that shouldn't exist everywhere else in the world.
Yeah, and just on that though, I think it's important to draw a distinction between a matching engine and maturity transformation. Yeah. What they're not doing is maturity transformation. They're a matching engine for somebody on the other side, a lot of these businesses. And that's not the same as a bank. Sometimes that point gets a bit confused.
I think the big issue on growth of all this stuff is funding, right?
Yeah.
So, you can raise funds, private equity funds, credit funds that are setting up to do this. And then the question is, are there securitization markets that because this stuff can be securitized if it's consumer risk. And that's tough. I mean, it hasn't gotten to a scale. So the scale of this stuff is tiny relative to the 40 trillion in the banking system. So this is way on the edges. I mean, even if it's a couple billion or 10 billion, it's tiny actually when you think about it relative to the scale of what's needed.
Time for a couple more questions. Yes, lady in front.
Hi, I'm Kate Zhao from Fosun International. We're actually one of the Chinese companies doing lots of global acquisitions, as you said.
Yes.
And Apollo wasn't being unfamiliar with our name because we sometimes are competitors, sometimes are cooperators, right? My question is actually for Moody's, for Colin, because our rating kind of very different, has a very big difference domestically versus globally. Both Moody's and S&P rated us on the corporate debt ratio level. We tried very hard this year for deleveraging, like selling different types of assets for exiting and getting deleveraged. It actually happens to lots of Chinese companies doing aggressive acquisitions these days globally. There are rating agencies challenging whether they have the money to fund all those aggressive acquisitions, whether they are paying a premium that shouldn't be paid. I was wondering whether you can explain more about the two different systems of Moody's like rating Chinese domestic companies or companies with headquarters domestically versus the other global companies.
Okay, so just to make sure I understand the question, it's kind of the domestic currency rating versus sometimes what is a foreign currency rating?
Yes.
Okay, sure. Well, I mean, in essence, it's all about the access to the resources. If we saw a firm which had a large stock of foreign currency assets to back or potentially to be drawn down for foreign currency liabilities, then you might not see a huge gap between the foreign currency and domestic currency ratings. But at the end of the day, you know, if there is a crisis, a domestic crisis somewhere in the world, and I'm not going to pick on China, if there's one in the UK, the one thing the UK is never going to run out of is sterling. Because it can always, in the old-fashioned world, we always used to say that it could print some more, but actually it's all electronic now, so you can just type in some more. So defaults on a local currency basis within a domestic banking environment are really ultimately driven about concerns with the kind of the fiscal theory of the price level and inflation. So it's kind of the old mechanism where you can either fund your borrowings by printing money as a government or by issuing bonds, and we haven't done the printing money for a long time, and we're still not doing it yet, despite what some people think. But you never run out of your domestic currency. And if you are a government that cares about systemically important institutions or maybe just a swathe of corporates, you can always provide that domestic currency provision. Whereas in a foreign currency environment, as we saw 97, 98, with a number of corporates, and indeed some sovereigns that saw distress at that time, you know, if you're borrowing or you're issuing in sterling and you don't have direct access to that, then you're reliant on your own ability to generate those sterling-based funds or to convert at the prevailing market rate to meet it. So it's just a different way of looking at how we do things.
Time for one last question, if there's another question. Otherwise, I'll pose a last question to the panel. Very quickly, because I just think it might be kind of interesting. If you were a regulator at the moment anywhere in the world, where do you foresee the next crisis? What is the most likely source of the next financial crisis?
Dare I say emerging markets? Probably. Emerging markets have been playing an important role in redistributing funds around the world. We are going to see the winding down of the balance sheets of the big central banks, the Federal Reserve, the ECB, the Bank of Japan, and this is bound to cause a calamity somewhere in an institution that has not quite plugged into the global macroprudential.
Emerging markets, Colin, briefly?
I have some sympathy with that, but I think a lot of EMs are better placed than they were in 2013. I think they reacted following the taper tantrum. The one that I spend a lot of time thinking about at the moment, less in terms of the likelihood, but definitely in terms of the hazard, is the euro area. You know, it's still institutionally flawed. We were talking about it in the previous session. I don't see the political will to make the necessary institutional changes to put it on a sound footing.
Well, I mean, one potentially is Chinese real estate lending. I'm not sure how much thought has gone into the provision of capital by the banks in China, but there's potentially an issue there. But it's a big economy. They probably can absorb some shocks.
Joe?
We think.
Because of the political unknowns on the calendar next year, I'd say the Eurozone.
And Sanjay?
I think say China NPLs.
There we go. So there's plenty of places to look if you're looking for it. Thank you so much indeed for joining us. My thanks to Sanjay, to Joe, to Dominic, to Colin, and to Youssef as well. Thank you for your time joining us. Hope you enjoyed the discussion. Thank you very much.